Thanks for joining us in Power Lunch. This is Bloomberg Quint and I'm Meera Dugal. Let's get you the headlines. The Nifty and Sensex declined over 1% each to trade at the day's lows. Yes Bank slumps 10% following two block deals. Finance Minister Nirmala Sitharaman will meet chiefs of public sector banks to seek faster transmission of policy rate cuts. The US Federal Reserve cut interest rates by 25 basis points for the second time in a row. Policymakers, however, remain divided over future course of action. US President Donald Trump has asked his Treasury Department to explore tougher sanctions on Iran following the drone attacks on Saudi oil fields. Iran has denied any role in the incident. All that coming up in a minute, but let's take a look at markets first. Darshal is here with us.
Yeah, so basically it's one more day where we are seeing more than a 1% cut that's coming in on the Nifty. So more than 100 points down on the Nifty, over 350 points down on the Sensex as well as the Nifty Bank. So it's a very weak day. All the sectors are trading with a negative bias. Majority of the losses are coming in the metal space, PSU banking space and pharma space. So there is enough selling that's happening. Some of the stocks that are in focus, first of all, there is PC Jewelers, which is down 10% in trade. One of the biggest drags as far as the market is concerned. Yes Bank, multiple block deals that happened there, and post that it's trading at the lowest point of the day. Probably it will be at multi-year lows now. Dish TV and Z Entertainment, both of them are down almost 8% in trade. So there is selling among the names which always usually are on the negative side. Vodafone Idea has benefited because of the IUC charges, that report that came out, and it's up almost 13%. Tata Communication is trading X the real estate business, and it's up for the second day in a row. So there is traction that's happening there. And a couple of other companies, ICICI Prudential, Dewan Housing and Tata Motors are doing well. Tata Motors, remember, has the big press conference today in terms of their e-mobility business, but nevertheless it's acting up in today's trade.
Darshan, thanks for that. That's the equity markets. Let's move on to global action. Central bank action has been thick and fast coming in since yesterday. Bank of Japan has chosen to leave its interest rates unchanged at a negative 0.1%. The Japanese central bank will also not change its asset purchase program for now. However, there is some indication that there could be a review of their policy stance at the next meeting because the Bank of Japan said it would pay closer attention to the possibility of losing momentum towards its 2% inflation target as overseas economies continue to decelerate. Meanwhile, overnight in the US, the Federal Reserve cut interest rates by 25 basis points on expected lines. Fed Chair Jerome Powell cites the damage caused by the trade war with China, but emphasized that the US labor market remains strong. What's got financial markets worried, though, is the future course of action.
If the economy does turn down, then a more extensive sequence of rate cuts could be appropriate. We don't see that. It's not what we expect, but we would certainly follow that path if it became appropriate.
Bloomberg's Kathleen Hales tells us why many saw this as a hawkish cut and left the markets complaining about the lack of guidance.
Jay Powell, basically, the Fed has left the door open to rate cuts to an extent, but there are some who are not signaling that they're open at all. So let's get into the details here. Yes, a 25 basis point rate cut. Fed talked about moderate growth in the economy and a strong job market. Now, a lot of economists have been saying going into today, how can they say the labor market's strong when payrolls are on a clear downtrend? So that's one point I think that bothers some people. But they did say they're cutting rates as insurance, doing it for a second time. Insurance against the global risks materializing. We've seen the global economy slow down. We know the trade war is continuing to chip away, do its damage. And of course, when you look at the dot plot, I mean, people who were watching the rate cut, looking at the policy statement, when they saw the dot plot on the far right-hand side, there's three piles of dots, right? The one in the middle, there's 5 of them. And those 5 said, okay, we cut the key rate. Great, that's all we need to do in 2019. The 5 above them said, we don't want to cut even one more time. That has to be Esther George and Eric Rosengren from the Boston Fed. They both dissented. And the row along the bottom is 7 saying, we need to cut one more time. Why is this looking so hawkish? Well, number one, because it's only 7 of 17 who are looking for that other rate cut, and there's nobody looking for 2 more. That's what the more bullish guys in the bond market have been pounding the table about. And again, I think this lack of guidance, when you have 2 Fed bank presidents as voters saying, we don't want to cut it all, when you have Jim Bullard from the St. Louis Fed saying, I want 50 basis points, even if Jay Powell says, yes, if we need to cut rates again, we can do a sequence of rate cuts, it still makes people wonder what is going on. And it certainly isn't as dovish and as concerned of a signal from the Fed as those people had hoped for.
That's the global action on the central bank front and the economy. Let's bring it back to the domestic economy. Now, India's GDP growth rate fell to its lowest in 5 years. Consumer spending was on the decline. But what is the information that has come in since then? What do we know about the next quarter, which is the July to September quarter? Joining us to talk about the state of the economy is JPMorgan India's chief economist, Sajjid Chinoy, joining us from the sidelines of JPMorgan's Investor Summit. Sajjid, thanks for joining us on Bloomberg Quint. Let me just first ask you what you see in the data since we got the GDP release. It certainly looks like sentiment has soured, but has data worsened as well?
Well, the hope is that, the worst has been seen, but I think any cyclical recovery is going to be gradual. I think the August data was not particularly encouraging. The PMIs were lower. If you look at exports and imports sequentially, they've contracted. And non-food credit growth has also slowed, which is a surprise given that, there's now sufficient interbank liquidity. The RBI is on an easing stance. So I don't think that the bottom has been reached, at least as per the August data. But I think for the quarter as a whole, we would hope that growth, picks up a little bit above 5%. I think we have to brace that this is going to be a modest cyclical recovery. For me, the key is going to be when consumption comes on stream, because I think what we're in the midst of right now is a lot of risk aversion on the part of households. Some of this, I think, has to do with sentiment, which could reverse quickly. But some of this has to do with the fact that they've run up a fair amount of debt in the last 4 or 5 years. A lot of household consumption has been financed either by running down savings or taking on debt. And when you go through that process, every time you're hit by a shock, if the shock sustains for long enough, households can recalibrate future income expectations and therefore consumption. And therefore, coming out of that process could be a little bit slower and take a little bit longer than we'd otherwise like.
Sajjid, this fall in bank credit growth seems to be interesting because there's ample liquidity. What's behind that?
I think it comes down to risk aversion. What you're seeing is when you are, in the midst of a 3-4 quarter slowdown and sentiment turns adverse, all economic agents, whether it's households, firms, financial intermediaries, tend to become more risk averse. I guess what banks are thinking is they've just come off a bruising NPA cycle. And to the extent that growth has slowed and credit risk perceptions have increased in the economy, whether it's households, whether it's small, medium enterprises, banks at this point don't want to take undue credit risk. So I think that's what explains why the transmission through of RBI rate cuts has been less stellar than all of us would think. Some of these, of course, are technical issues, liquidity, small savings rates. When there is movement back from shadow banks to regular banks, financial conditions tend to tighten. So there clearly are some technical reasons why transmission has been weaker. But I think some of this comes down squarely to risk aversion on the part of banks.
The other incremental source of worry is declining pricing power. The WPI data showed zero inflation on the manufactured goods side. Is that worrying?
That's right. I mean, and you don't even have to look at the WPI data. Just look at the CPI data. If you look at the August CPI print, core inflation, which is what we track, month on month was very soft, and all of the increase was essentially gold. If you take gold prices out of core, month on month, we're essentially tracking zero. More broadly, if you step back, you can clearly see that output gaps have opened up and pricing power has reduced because the annualized momentum of core inflation was running at 6% in the last 6 months of 2018 and is running below 3% in the first 7 or 8 months of 2019. So when you have such a large fall off in a matter of months, it suggests that there is clearly a cyclical component to this. Output gaps have opened up, pricing power has reduced. But it's easy to get caught in a spiral of gloom and doom. You have seen in the past that when some of these downturns are driven by sentiment, things can bounce back also meaningfully. I mean, one simple example is I think a lot of households have postponed demand for autos, for example, or other consumer durables because they think GST cuts are coming. Now, hopefully, once that uncertainty is resolved at the GST meeting this weekend, then households, won't be incentivized to further postpone their consumption. So hopefully there'll be a little bit of good news there. The other thing is oil prices have retreated from their highs. That's a bit of a relief. And even globally, the fact is you had, almost 24 central banks cut interest rates over the last few months. So hopefully the global outlook won't be as gloomy as one had thought. So we have to look for, signs of hope wherever we can find them.
All right, Sajjid, let me then ask you about whether you're hopeful that any of the steps taken by the government will help, or do we at this stage need broader fiscal stimulus either through tax cuts or through spending?
On the fiscal front, ideally, this is the environment where monetary policy efficacy is reduced because of heightened risk aversion on the part of financial intermediaries that would call for a counter-cyclical fiscal push to break this negative cycle. Of course, as we've discussed before, there is no obvious fiscal space, and the government has, to its enormous credit, exercised strategic fiscal restraint. But there is one thing they can do, and I think we're hopeful that that will happen, which is to really front load or to double down on asset sales. Because as we've said this before, to the extent that you can meet your fiscal deficit target, keep to the same target so borrowing requirements don't change, but to the extent that you can meet them through more and more asset sales, the effective fiscal impulse for this year will be larger and more expansionary. And I think that's the one bullet that can still be fired, that we should meet that disinvestment target. Ideally, you want to exceed that, and the fact that the RBI extra dividend is about 0.3% of GDP also means even if you stick to the same fiscal deficit target, the fiscal impulse, which impacts growth, could actually be positive. So the hope is that in conjunction with slightly better easing of monetary policy in the coming months could provide some counter-cyclical support.
On the monetary policy side, do you think data is weak enough to justify, say, a 50 basis point cut in the next policy?
Well, I don't want to be overly prescriptive here. It's a difficult time, and the government, to their credit, has tried a variety of things. For me, the concern is not so much ideological. Fiscal policy is being used in different parts of the world. It's more, what will the impact of the bond market be? What you've already seen is, just look at the term premium in the bond market. The overnight rate's at 5.4%. Swap markets have priced in more rate cuts, so expectations are more easing will happen. And yet the 10-year bond is trading at 660, or it even went up to 670. That 130 basis point spread or term premium reflects some of this fiscal overhang. And so for me, the concern is that if the government were to legitimately say that the deficit needs to widen, then and borrowing requirements go up domestically, that just puts more pressure on the long end, and it further impedes the efficacy of the RBI rate cut. So that for me is the concern, that any fiscal expansion is counterproductive to an extent because it makes the monetary transmission even more imperfect.
Last word, Sajjid, where do you expect rates to settle in the current cycle?
So we do expect at least a 25 basis point rate cut in the cycle. Ideally, I think what the RBI should do is keep doing small increments, because because that's what keeps bond markets interested. If you do a disproportionately large cut and markets feel that you've exhausted space, ironically, that gets you less transmission, as we saw after the August policy. I think there are a lot of moving parts here, but given our own models of where the output gap is, if one assumes that oil settles at current levels, 63, 64, and inflation, in the first half of next year is still modestly below 4, I think the central bank still has room at least to go to 5%, which means another 40 basis points of cuts from here. I think after that, it'll have to be very data dependent.
Sajjid, thanks so much for joining us on Bloomberg Quint. Meanwhile, the Finance Ministry will meet public sector bankers today to take stock of the 110 basis points in rate cuts that have already happened and the transmission on that. The government also wants an update on some of the other measures announced by the RBI and the Finance Ministry at this meet. Nikon Jory has the details.
Finance Minister Nirmala Sitharaman, along with Finance Secretary Mr. Rajiv Kumar, is going to head a meeting with 10 public sector banks that were recently amalgamated or merged. there's going to be a review of transmission of lower interest rates and products that these banks have introduced which are linked to repo rate to step up affordable credit in the economy. There's also going to be a review of several measures taken by these banks to advance loans to MSMEs, self-help groups or small businesses. The finance minister is also going to review the partial credit guarantee scheme which was introduced in the budget, where public sector banks were supposed to buy pooled assets of NBFCs. There's the 10 public sector banks that have been invited for the meeting are heads of Allahabad Bank, Andhra Bank, Canara Bank, Corporation Bank, Indian Bank, Oriental Bank of Commerce, Punjab National Bank, Syndicate Bank, Union Bank of India and United Bank of India. There's also been a request sent to heads of State Bank of India and Bank of Baroda to attend the meeting, which will be chaired by the Finance Minister.
Reliance Jio continues to expand its customer base at the cost of rivals. It was the only operator to add active users in the month of July. Somit Sarkar is standing by with the data.
Well, if you see in the month of July, Reliance Jio was the only operator to add active subscriber base, while all the other telecom operators had seen a decline in their subscriber base in the month of July. Now, though Jio added most number of active subscribers, in the month of July, the quantum of addition was lower compared to last month, where it had added close to 1 crore subscribers. In the month of July, it had added only 40 lakh active subscribers on its network. Also, though Reliance Jio is now the second largest telecom operator by customer base, the number of active subscribers continue to remain low on Reliance Jio's network. Now, Airtel, if you see, yet again in this month, it has seen a decline in its active subscriber base, and this is despite the fact that the subscriber numbers included the numbers of Tata Teleservices. As you can see here, it has seen a decline in its active subscriber base for the last 9 consecutive months. And in this last 9 months, it has lost close to 2.8 crore active subscribers, which could be attributable to the minimum recharge plans that that the company had adopted in the last 9 months. For Vodafone Idea, if you see, they have seen a continuous decline in the active subscriber base now for the 15th consecutive month. In the month of July, they lost nearly 1.1 crore active subscribers, and in the last 15 months, they have lost over 10 crore active subscribers. That is for Vodafone Idea in the last 15 months. Now, if you see, on the broadband side, who are generally the high revenue generating customers for these telecom operators, because they primarily use data, and that is the only thing that is being charged currently by the telecom operators. Here, Airtel has seen a strong subscriber addition. They have added close to 24.5 lakh active subscribers, and they have been continuously adding a good number of broadband subscribers on their network. On the other hand, Vodafone Idea's broadband subscriber addition was negligible at around 4 lakh, which could be attributable to the under-investment done by Vodafone Idea on 4G expansion. Lastly, coming to market share, if you see, due to addition of Tata Teleservices, now Airtel stands the #1 operator in terms of active subscriber base. Its active subscriber base market share is close to 32.1%, while that of Vodafone Idea falls to 32%. Reliance Jio's active subscriber base market share increases to 29%. Now, for Vodafone Idea, if you see, they have seen a sharp drop from 37.6% to close to 32%, while that of Airtel has remained largely stable so far in 2019 at close to 32%.
Somit, thanks for that. That's a wrap on this edition of Power Lunch. Thanks for watching.